Okay, very good morning. Welcome to the briefing for Thursday, the 3rd of November. Hope you all had a good evening. Firstly, just a quick catch up on last night. Obviously, we had the FOMC statement. Not a great deal coming out of that, to be honest. I think that was largely as to be expected. A placeholding meeting is what it was being termed, and that's ultimately what it turned out to be. Just the Fed setting up the move in December while leaving rates on hold. A few small tweaks to language that we're seeing. Policymakers, while saying the argument for higher borrowing costs strengthened further amid accelerating inflation, reinforcing expectations then for a hike next month. What was quite interesting is you had 3 dissenters last time, and that dropped to just 2. So Mester and George continued to dissent. They were calling for an immediate hike, but Eric Rosengren, who's the president of the Boston Fed, he pulled away from his previous call in September to hike rates and fell back into the majority to keep them on hold for the time being. Obviously no explicit reasonings behind him specifically and why he did that. We'll have to probably wait for the minutes before we get those details, because last night was just the statement. No new projections, no conference with Janet Yellen. And as I say, not too much of a real move on the back of that. And that's because really there's a lot of things going on at the moment from a negative point of view, I would say. And that certainly is playing out in the S&P. I've kind of got my chart in the middle shown with you at the moment, and it's the last, let's say, week of S&P trade. And I saw a statistic that the S&P, having closed down around 0.65% last night, has now clocked up its 7th consecutive losing day in a row. That's the longest losing streak now since November of 2011. In terms of the catalysts, obviously the closeness now of the election race, which obviously was a much wider margin only around a week ago, but given this new turn of events with the FBI investigation, certainly now it's a bit more of a toss-up in terms of the actual outcome of this election race. That's the first and foremost biggest driver at the moment of the financial markets. You've got oil continuing as well to be under pressure. Obviously yesterday we had that huge size build. We were kind of thinking, well, the APIs came in at something like 9.3 million build, which is very unseasonable for this time of year. And then we came out, obviously, that big red candle to the downside. We printed a low briefly sub 45 in crude after we had that jumbo headline build, I think over 14 million. US output also up over 0.2% as well. That in combination with this breakup of the agreed deal in Algeria, given the various exemptions, and then various other countries ramping up production, in fact, doing the complete opposite. So you've got both on the demand and supply side dynamics weighing on crude, and ultimately, as that's pulled back around $5 in a matter of days, really. We were up at $50 back in the end of last week. We tested and briefly broke 45 yesterday. So that definitely as well is another force that's weighing on equity markets. Then you've got the fact that the Fed, obviously last night, just reaffirming, if anything, that they're going to hike rates in December. Taking a look this morning at where the current probabilities lie, and it's crept up a little bit on the CME Fed Watch, 71.5% probability now of a rate hike. On the Bloomberg readings, that's tracking a little higher, around 75%. So certainly as well, the market's got to deal with, around all this political and economic uncertainty, you've also got to deal with the fact that the Fed are going to hike interest rates for the first time in 12 months into what could be a fragile situation. So that's also making the equity market a little nervous as well. The other things, the Italian constitutional reform referendum, that of course is kind of on the back burner at the moment. People are so focused on the US election, but certainly that's something to look out for. We're starting to see a lot of polls coming out now on that regard. Actually, I can see one right in front of me at the moment on Twitter, an IXE poll saying for the Italian referendum, no is at 39%, yes at 37.5%. So that's kind of mimics a lot of the other polls. It's extremely close at the moment. And obviously that carries its own political risk, with Renzi doing a David Cameron and pinning his political future on the back of the outcome of that decision. Then finally, of course, you've got Brexit concerns still lingering at the moment. So everywhere you look at this present point, it's quite hard to find any type of positive news, and you're kind of seeing that play out now in the financial markets, because not only are we seeing the longest down streak in the S&P for 5 odd years, let's have a look at gold prices. And obviously we've been talking about this a lot yesterday, but we broke psychologically the $1,300 handle, but we did not sustain that move. This morning we are $4 shy of that level, but certainly we've seen a $50 rally in gold futures in less than a month. It was the 17th of October when the rally really begun, and it took only up to the 2nd of November before we snapped back and reversed that entire technical kind of break on that Fed hawkishness that we initially had back in early October. Okay, so let's have a look at a couple of things then that we've got to be aware of for today's session. Firstly, a quick recap of the state of play for the US elections. You remember this chart I've showed you before on Real Clear Economics, and it's this number in particular that's interesting, because I think when we looked at this last week, that number was tracking at around 268, 265. So basically Clinton was already a shoo-in even without winning a single swing state. It was that kind of leaning on the Democratic victory. Whereas now, just given what's happened and the close proximity of these latest polls, that's fallen to 226. And what's interesting here on this this top kind of timeline or graphic is you can see that's 270, that marker there where my mouse is now. So she in fact does need to pick up a few of the swing states in order to get over the line. And certainly the Republican now that are more firmly leaning that way has grown by a large amount, given not so much Trump doing anything extraordinary, but more so Clinton falling in popularity given that latest scandal with the investigation by the FBI. Looking at the latest polls here, this is the RCP average, so averaging out all of them. North Carolina is one of the real key ones in terms of college vote size. That's the third largest after Ohio and Florida, and at the moment that's going to be really key as well, because Florida is leaning Trump, albeit just slightly. Ohio more convincing to Trump's support at this point by a 3.3 advantage. Alongside the other smaller ones, Clinton, Colorado is another sizable one at 9. Maine is very small and insignificant really, so Clinton's got a little bit of work to do here, but I'm sure, and I have no doubt, and I think we've already seen it last night, there was a new video campaign about where the Democrats have basically collected every derogatory comment that Trump has made against women and basically made a music video out of it pretty much. And also there's been reports about Trump having raped a 13-year-old girl many years ago. I would imagine that there's going to be plenty more of this type of news flow over this weekend. This weekend, if I was on the campaign trail, I would be, right, this is when the big guns come out and the real nasty stuff starts coming to the surface. So I think there's still a lot to play for. I would certainly be watching these polls. We had yesterday, I think, something like 15, 20 polls I remember seeing or hearing on the Squawk coming out. I would say there is a degree of exhaustion to a certain extent. I would say now that things are pretty close, what's potentially going to be more market impactful is if there's one particular swing state that starts to take a bigger lead of, let's say, 5 to 10 point advantage, where most of the toss-up states are more generally speaking within around a a 2 to 3 point range at the moment. So that's the US setup. The other thing, of course, though, that we need to be looking at today is the UK. There's a number of big things coming out of the UK today. Actually, before we get on the High Court, let's tackle it chronologically, because we have the service PMI is going to be up first, and that's at 9:30. So this is the most important of the PMI numbers we get through the week. We've obviously had manufacturing and construction. This one accounts is the biggest hitting in terms of its representation of how our economy is made up. But timing is key, and this figure comes out at 9:30, when I think ultimately more people are going to be awaiting the decision that comes out of the UK High Court ruling in regards to the Brexit decision. Looking at the service PMI number, the number that we're looking out for today will in fact be the October reading, so likelihood is we still could see a bit of a boost, as we have done, as was evident in the GDP figures last week. The service sector still benefiting from foreign demand, so hotels, restaurants, shops, kind of spending luxury goods from foreign buyers still helping prop up the service sector, and I would imagine that would probably still remain the case, albeit maybe slightly off the previous high levels that we saw above 52, but I'd still be looking for a number around those levels. That being said, then brings into sharper focus the situation with the UK High Court. We've obviously been waiting for this for some time, and this I feel will probably be arguably the most market moving event for the pound today, even though we have Bank of England Super Thursday and that kind of faceted event coming from them at 12 o'clock. Looking at this decision first, though, I think Deutsche Bank sum up very nicely. Whichever side loses today, they will likely appeal in the Supreme Court. Again, the ruling's at 10 a.m. our time. So whoever loses will likely appeal to the Supreme Court with the hearing in December. The perception is that if the result goes against the government, it would force a softer Brexit plan, with the more pro-European Parliament shaping any Brexit discussions, rather than a hard Brexit bias that has been coming from the ruling Conservative Party over the last month. So as we've seen with the various rumours that have swirled in the last 2 weeks or so, whenever there's been any intonation towards the government or this vote having to be needed to be ratified within Parliament, i.e. going against the government having the overarching sort of responsibility or ability to better make that decision on their own, then that's been a sterling positive. And that still is how I'd kind of view the situation here. The one thing though, and I think I agree with Deutsche, is that they don't think people believe that they'll reverse Brexit, as again the perception is that Parliament would respect the will of the people in June's referendum. So it's not like they're going to call off Brexit. It's more so that Theresa May might need to soften the kind of hard stance, which ultimately is going to make it more beneficial for the pound, that we're going to avert this worst case scenario that the rougher or the more aggressive we are with Europe, the rougher deal will ultimately get. In the near term, the risk reward is perhaps skewed to the upside for sterling, as there are large shorts which would likely be covered if the vote goes against the government. So again, as most banks, I think I've still got it on my chart from what we looked at previously, a lot of the banks are looking at these year-end targets down at 116, GS at 114, hard Brexit 1 year forecast at 105. That's obviously quite away from current price activity. So a lot of the market's probably heavily short for fundamental reasons. It makes sense. Economic data is going to be deteriorating. So if this goes against the government, what they're saying, Deutsche, is a lot of those shorts might be covered and therefore could cause a further, more aggressive move to the upside. Looking technically as well, we're sitting kind of at the precipice of the range that we've defined over the last, well, I'd say 2.5 weeks. That was the algo flash crash that we had. Let me bring my chart up. So the flash crash occurred there. We are now at the top end kind of that range, which was on the 19th when we printed up at 23.47. We tested that back on the 2nd failed to break. We did it again yesterday and failed. We've had this morning a breakout up towards R1 and then back to that exact level. So I think this is kind of key where we're sitting at the moment. Obviously, if it goes against the government, then we could see 124 probably for sure. But we start to open up. You can see here technically some open air. On the downside, obviously if the government continues to have power, which is still a strong possibility that will continue to be the case, that this just gets essentially booted out like what we saw with the Northern Irish ruling only a few days ago, then downside would likely materialize. Probably that first target would be down at 22.84, which was those respective highs. It was providing resistance back on the 27th and then earlier this month on the first trading day of the month. Then even below there, depending on what we're looking at here is an asset that's rallied pretty aggressively over quite a short period of time. So from the 31st up to today, where we are on the 3rd, we have rallied from sub 22 handle to really just shy of the 24 handle. So likewise, as much as there's room technically on the upside of clean air, there's also room for fairly aggressive pullback. And if we get through that 22.84, then probably the 122 handle, I'd be not afraid to rule that out on an intraday basis, given the gravitas of this ruling today. The next thing that you've got then is the Bank of England. You've also got the Bank of England's Super Thursday, it's known, because today we get the interest rate decision, you get the vote count, you get the press conference, you get the quarterly inflation report. So it's the full Monty, so to speak. And it's all going to come out at once. So you're going to get a lot of headlines hitting the tape. Don't forget the minutes are coming out as well. So how this generally happens is that at midday, you'll get, first of all, the announcement on rates. And we're definitely not expecting anything on that regard. It's not about the interest rates, much like the Fed last night. So then we get the asset purchase facility. They're not going to change that either. So that first call will likely be unchanged on both accounts. The minutes then, the vote split is expected to be 9-0 to make that decision of no change. That's the broad consensus view. I think anything other than that would be a shock for the market. And then you get the quarterly inflation report to come out. So that comes out and you're looking out for their 2-year horizon projections on growth and inflation, and by that then you can determine what their future interest rate path is over the medium to long term. Now, I probably don't foresee too much of a reaction on the back of this, given the fact that probably the Brexit ruling is going to be the main dominating theme of the day. The FT, though, I did send this out to you guys this morning, so please do take a read in advance. But just in summary, this is what you need to know in order to navigate the event. Obviously, the currency, they're going to be questioned on. Mark Carney and his team will have a press conference at 12:30. And obviously, depreciation of the pound will come into focus. And that then leads us to this translation into how the markets have reacted and what's caused this plummet in gilts, a spike in yields on the back of really the inflation argument. Now that prices are starting to creep higher, this I feel will be probably the most key point of how he'll be questioned going forward. Obviously, back in the last quarterly inflation report, we were at a juncture of policy where we were talking about an extension to a large and multiple degree of more monetary easing. We're now very far from that. We're at a point where he probably wants to keep the door open, that's still an option. However, that their hands are somewhat tied at the moment and they continue to monitor prices and for future direction of policy. So his tolerance, he's already mentioned that word, and that's key. His tolerance for inflation to overshoot. So he knows that's likely to be the case in the short to medium term. It's how far does he think it's going to overshoot, and how does he think that policy should be manipulated in order to counter that. Let's not forget, NISA yesterday were talking about inflation in the short term could go as high as 4%, which would be uncomfortably high for the Bank of England. So they're the key things to look out for there. A quick look at other things. Let's not forget, from the US today, we do actually have a couple of interesting things coming out. Initial jobless, ISM non-manufacturing. I would say, though, the interest rate decision is still December is the key date, and that's not until the 14th. So we've got a good 5 weeks or so until that occurs. So I don't think data is really going to be too influential. It's going to be a very, I think, UK sterling oriented day, hinging on really the 10 o'clock announcement. With that announcement, I'll have a look a bit more into it in terms of the exact timings. I read something yesterday about they're going to meet, then it could take a half an hour session when then the actual announcement gets made. This isn't kind of a one and done, i.e. like a data and it comes out bang on at the minute. It's probably not going to be the case. Probably the judge will give the announcement, so it should provide an opportunity for the swift of hand to be able to action a trade. It's not going to be like an algo-driven fast money move like on a piece of data. So obviously I'll be keeping an eye out for any rumours or Twitter leaks, anything like that could potentially arise. I would say then trading around the data as well for the UK at 9:30. Depending on how it comes out, as I say, I'm looking for something not too different from what we saw in the prior month, so in line roughly with expectations. But if there is a trade opportunity around that data, you want to probably be pretty quick with your time frames on executing that trade, because then ultimately the liquidity might dry up as the market awaits the announcement at 10. Okay guys, I think I'm going to leave it at that. ISM non-manufacturing later on this afternoon at 2 o'clock. Factory orders as well coming out at the same time. So these are significant numbers still, particularly the employment component of the ISM figure, because we're still trying to formulate the overall picture for non-farms, which is obviously tomorrow afternoon. Okay, enjoy your session. I'll be in the chat room as normal. Any questions, let me know. Otherwise, enjoy the session, and good luck with the pound today.